Barbarians at the Gate is written by Brian Burrow and John Hellier. They were journalists at Wall Street Journal at the time, and they were writing the book as the biddings were still going on in the late 1980s. They had the chance to make interviews with the characters of the book and used many articles published on the journal. So the book reflects the reality as best as it can. The main event of the book is the leveraged buyout of RJR Nabisco, which produced tobacco products under RJR and packaged food products under Nabisco, both of which still exists, although RJR Nabisco stopped operations a while ago. The book starts with the CEO's decision of having an LBO because the stock price doesn't increase no matter what they do. The LBO then becomes a much more complicated and longer process with unexpected players joining the bidding wars. Before moving into plot, let's look at some of the important characters. In the book, authors refer to them as the players. There are three main groups of bidders, and there are also additional important people. The first group is the management group, which involves Russ Johnson, the CEO of RJR Nabisco, and some close names to him, such as Ed Horgan, Ed Robinson, and Steve Goldstone. Management group is working with Peter Cohen from Shearson and Jim Robinson from American Express. Also, Solomon Brothers were in this group. And then KKR side was partnered with Drexel, Morgan Stanley, and Wasserstein Perella. The importance of Wasserstein is that first Boston joined the bidding wars to prove that their LBO department was still as good after Wasserstein left. On the other bidders, we have First Boston Group and Forsman Little. Forsman Little was important because Nick Forsman was an important person who believes that the usage of junk bonds and LBOs were wrong, but eventually he discovered it was impossible in the situation of RJR Nabisco to win the bid without using junk bonds. On other important people, Charlie Hugel was on the special committee and didn't want the management group to win this LBO war. Peter Atkins at Skadden Arps was basically conducting the whole bidding and negotiation process. Linda Robinson played a huge role in trying to bring management group and KKR to work together. She was so close to success, but then the two sides decided to go separate ways. And finally, Joan Grenius, he was the president of Nabisco Division, and he played a huge role in due diligence of KKR because before him, no one from management was giving any valuable information to KKR. So the book starts with Kravitz's suggestion for an LBO. However, Johnson rejects it at the beginning of the book. And then Johnson later wants to keep management and have an LBO to increase share price. So he decides to work with Shearson and American Express, and he teams up with Cohen. Their initial bid was much lower than the company's value, which opened the door to additional bidders, such as KKR, which is why Kravitz wanted to join the bidding wars. And then Cohen at first wanted to work with KKR, but that didn't work out. And then Forsman Little wanted to join, but they couldn't raise enough money for the bid without using junk bonds. And lastly, First Boston Group wanted to join the bidding wars as well. And initially they won, but then Cohen insisted on extending the bids. And at last, management group had the highest bid, but with special committee's decision, KKR won.
Now, let's talk about a couple of key things you need to know to aid in your understanding of what's going on between RJR and Nabisco and the firms trying to buy them out. Most importantly is the leverage buyout. And essentially what that is the acquisition of another company using a significant amount of money to meet the cost of the acquisition. And often a large part of this money comes from banks and other financial institutions, as well as private investors. Now, typically this buyout consists of about 90% debt and 10% equity. which they're able to do by putting the company that's being taken over's assets as collateral, and in some cases, the assets of the company doing the takeover as well. And by using these assets as collateral, they're able to take on larger amounts of debt, which require large amounts of interest payments to be able to cover. And what's so key to the leverage file is that interest payments are able to be written off of income taxes, effectively creating a tax shield for the company that improves the bottom line, which creates more return for investors. Now, this return is created for investors because, as a result of the high debt to equity ratio, the bonds issued are junk bonds as opposed to investment grade bonds. Junk bonds carry a higher risk of default than most bonds issued by corporations to the government because they are bonds issued by companies that are struggling financially and have a high risk of defaulting and or not paying their interest payments. They also have a much higher yield to offset this risk, which is what investors here are looking to take advantage of. That is because buyouts typically target firms that may be underperforming or undervalued, meaning that these junk bonds have the potential to significantly increase should the company's financial situation improve, which is exactly what the takeover is trying to do by trimming the company for the purpose of improving their financial performance and to pay off debts incurred during the LBO. Now, typically, they're done for one of three reasons. The first of which is to take a public company private, to take a portion of the business, spin it off on its own, or to transfer private property, which is usually done for a change in small business ownership. Now, you may be thinking, LBOs are a great way to make profit, and while these acquisitions can make millions of dollars for their investors, it can also lead to the bankruptcy of the company being acquired. This typically happens when the investment is over-levered, or there is too much debt to the point that the company's operating cash flows are no longer adequate to pay back the interest payments on the said debt. And lastly, LBOs are complicated and time-consuming financial transactions. And so in general, you're not going to see as many of them nowadays, with most of the largest in the past couple of years being PetSmart for $9 billion in 2014 and Krispy Kreme for about $1.5 billion in 2016. Because most LBOs occurred and failed in 2006 and 2007 before the housing bubble, that sent most of them and their investments to the demise, and that's what's led to not that many being done today. Now, the other thing you need to know is about private equity. And private equity is essentially the ownership of an interest in an entity that is not publicly traded, in which the leverage buyout is a subcategory of. Now, private equity entails direct investment with the goal to gain influence over a company's operations, meaning that equity funds with a lot of money will dominate the industry because they can take over larger companies. Essentially, private equity firms try to work with high-net individuals and institutional investors like pension funds to accumulate the large sums of money necessary to make these large investments, with the hope that because they're making a large investment, they're going to be receiving a high return.
Okay, have you introduced the history of private equity and also its linkage to present days? So first of all, I want to talk about the reason for PE boom in the 1980s. There are mainly three reasons. Firstly, the stock market was going down. In the 1987 recession, the stock market crashed, and big companies do not have the incentive to issue new shares. So Wall Street companies turn its focus on earning commissions from M&A activities, because no matter the deal was a success or a failure, Wall Street companies can earn a huge commission from consulting fee, asset stripping fee, and loans. Then the second reason is that a lot of blue chip stocks at that time were undervalued, which provided opportunities for M&A activities. And then lastly, there's a lot of junk bonds at the market to provide a source of financing for LBOs. A famous one is Drexel Burnham Lambert, which was bankrupted in the 1990s. And then I want to talk about the mega LBO boom between 2005 and 2007. So on the slides here, you can see some of the most famous LBO buyouts during that period. In 2006, private equity firms bought 654 US companies for $375 billion, representing 16 times higher the level of transactions closed in 2003. And then in 2007, the private equity sector set another record of fundraising to 302 billion US dollars. On this graph, you can see the distribution of global buyout-backed investment exited, but the length of time held in fund portfolio. So this is basically how long private equity companies hold their buyout companies in their portfolio. So from the graph, you can see that between 2005 and 2007, the average holding period was pretty low. And after 2014, there's another downward trend again. So this urgency to sell reflects a number of factors. First, there's high demand for assets among both corporates and PE buyers. And second, there's economic signs of weakness. So firms are also looking to sell anything that is not tied down because a recession could make it harder to sell. And many companies are willing to trade a little bit below the IRR on current assets so that they can turn to raise a new fund, which can provide fee income and fresh capital to invest in the next 5+ years. And finally, I want to talk about the ethics of private equity buyouts. So the Barbarians, in fact, refers to those private equity companies. They aim to buy a target company with a short-term valuation and then sell it at a higher price to make a profit. If the target company's management do not cooperate in the process, the Barbarians will carry out a forced buyout and kick out original company management. The private equity company can boost the target company's short-term valuation by reducing its cost and reducing the bonus and layoffs. These actions can, produce short-term higher valuation and make the financials look very beautiful. However, it oftentimes can undermine the long-term competitiveness of a company, which could actually destroy value of economics. So just like Warren Buffett said, if you're looking to buy a company, do not buy it from the hand of a private equity company. That's all. Thank you.